Hey, good morning, everybody. It's Hammer. Today is Thursday, October 24th, 2024. I, of course, with Originator Success here with your daily mortgage rate update, the only place on the web where you guys get to join me live each and every weekday morning, 9:30 a.m. Eastern Time, broadcasted to you on Facebook and on YouTube. If you're here live, say good morning. If you're watching on the replay, don't forget to give me a hashtag replay in the comments. Let me know that you were here. Let Facebook know that you were here. Don't forget to smash that like button, tag an LO friend, share us in a group. Remember, you can go ahead and sign up for our free email lock advice, www.ratelockadvice.com. Just finish sending that out so you can use that any way you like. It's a quick overview. You can share that kind of a thing. Do me a favor, though. Don't tell consumers to sign up for it. That's the one thing that I don't like. We have a lot of consumers signing up for it, and it's I mean, it's not that they won't get it, but I just it messes up our database, quite honestly. But anyway, you can also sign up for our text alerts, www.ratetextalerts.com. You can sign up for daily text reminders that I'm going live if you'd like. And last but not least, check us out at originatorssuccess.com. Find out how we help you get loans from Google and social media. All that said, let's jump in strong this morning. Say hi to all our live folks here. Only a few of you that are on this morning. So I think it's because I have kind of bounced through everything a little quicker than usual. So good morning, Mr. Rob Stewart. Great to see you. Angela Walters, good morning. Mallory Fotiadis, great to have you here. Monica Dinkins, good morning. Amy Blauser, good morning over on YouTube as well. So great to see all of you. All right. Well, if anyone else is here live, I know there's a handful of you that are coming in. Go ahead and say good morning. Mr. Ron Siegel, good morning. National Food Day. Ron, according to Danielle DiMartino Booth, it is also National Bologna Day, I think. National Bologna Day, was it? Isn't that like she had the bologna thing on the on there this morning? Here you go. Let's see. It is National Bologna Day. Yeah, that's kind of crazy. Cindy Pulliam, good morning. Great to have you here as well. So anyway, all right, cool. Well, good morning, Gary Foote. Great to see you. All right, I'm gonna jump into the other screens. Let me start sharing some screens and let's get into the good stuff. We'll talk about where we're at this morning, what's going on, and all that jazz. So, first things first, mortgage-backed securities currently up 8 basis points to start the day, as you see here. That's always a better thing to see green than red. You know, let me zoom in on this for 1 month. Take a look here. Right down here, see this purple line? This is the 200-day moving average. This is a very, very solid support or resistance level. It's a very solid technical level. Yesterday, we blew right through it, right? So on Tuesday, we ended the day at 99.59. The 200-day moving average was 99.51. Yesterday, we went through 99.32. It started the day up at 99.49, right below it. Now, when you see a red candlestick like this, right, let's just kind of go over these again. When you see the top thin part, that is called the wick. That's why they call them candlesticks, because it looks like a candle with a wick. What that means is that's the highest point that the bond was at and selling for. Okay. When we've got the low thin line, that is called a tail. Think of sperm. Yeah, I know, but that's what it is. Think of that, right? That is the lowest point that they were selling for. Now, the thick, heavy part is called the body. That is the high part and the low part of where you started the day and where you ended the day. So, for example, on today, we started the day at the high part here of the body, right? And then we ended the day. Right now, we're at the low part of the body, and it's red, which means that we started high and moved lower. If it's green, you started lower and moved higher and ended higher. So, green candlesticks for our purposes here, of course, are what we want to see. And when we see these big red nasty candlesticks, that shows things getting worse. And we've seen rate sheets that match that getting worse over the last few days, pushing up, from 6.68, 6.82, 6.85, 6.92. Do me a favor, let me know in the comments, what what are rates that you're really giving at this point, right? So, and how much have you seen rates go up since before the Fed meeting? If you can have anything, I'm looking for you guys. I saw somebody post on Facebook, rates have gone up a point and a half on their rate sheet. You should not be seeing a point and a half jump in rates on your rate sheet, even with where we're at. Using Mortgage News Daily as a reference point, and the reason that I use this is Matt Graham does all the legwork, and what he's doing basically is just blending a bunch of rate sheets together, and there's no loan level price adjustments and everything else, but it should, as long as he's doing it consistently, which he does, it should be pretty accurate for seeing movement. Now, of course, you may not be quoting 6.92, but you may be quoting 7.25. But if this is 6.92 and this was 6.62, that's basically 3/8 of a point higher. So you should still be at 3/8 of a point higher, right? So looking here on this stuff, someone was saying that they were a point and a half higher. Now we were at 6.11, if you remember, before the Fed meeting, and we're still at 6.92. That's less than a point. If you've got a rate sheet that's a point and a half higher, then that means your lender is screwing your rate sheet. I mean, that's what that is. They're just totally just going nuts on the rate sheet. Um, I mean, that's you shouldn't be seeing that much of a move. Yes, we've seen things move, but when we look at mortgage bonds and mortgage-backed securities, right? Let's go ahead and just put the 3-month chart up here, and it's next to me and you guys can see it. I mean, here we were at the best level in September. We were at 101.61. Now we're down to 99.40. I mean, that's 200 basis points, but that's still a point in rate. You should not be seeing, that big of a movement. Ron said we're in the low sevens, about 80 basis points above where we were. Yeah, 80 basis points, which is what you would see if you used Mortgage News Daily as a reference point. Okay, it makes me feel better because when I see people post stuff like that, I mean, again, we were at 611, now we're at 6.92. That's 80 basis points in rate. When someone's, that they were a point and a half higher, and I'm like, either number one, they're either getting screwed on their rate sheets, or number two, they're just not doing enough loans and they are kind of thinking it all through. So, Sean said great info. All I can think of right now is a fried bologna sandwich. I don't know that I want fried bologna, but anyway, all right, let's get serious for a bit. And good morning to all of you. I see a lot of you on this morning. So we're up a few basis points. The PMI data is coming out in a few minutes, though. It could wash those gains right away. If the PMI data comes in strong, showing economic strength, we're going to see these gains totally wash out. We'll see bonds continue to move lower. Excuse me. Take a look at the 10-year Treasury yield, 4.22 right now. We had been capping out at 4.25 right about here. I'm going to put my head out of the way for a minute. Let's go bigger onto the charts. Good morning, Tom. You didn't really miss anything yet. We're just kind of talking about everything overall. So, in fact, here, let me throw some of the captions up here as I'm going through this. So, first and foremost, quick recap on yesterday. You can see here yesterday, mortgage-backed securities, we came out with pricing right here, right around 10 o'clock. They improved a little bit on the day and then lost that, gave that right back. That's just trade chatter, and actually ended the day slightly worse than where they were at 10 a.m. This morning, you see the straight line up. We had some help with some overnight gains. However, you could see that since the overnight gains, we have seen very consistent loss. Look at this. It's just going down like a ski ramp. See that? Okay. That's obviously bad. So yesterday was another bad day for rates, and they improve. Today, it's maybe the slightest bit better if we hold on to the gains, but it's not looking good. We were up like 10, 12, 15 basis points. They're falling away. We're going to get that PMI data in a little bit. Depending on how that PMI data, if it shows economic strength, which it likely will, based on the way all the other reports have been coming out, then we can see this go negative. So reprice risk on the day is moderate. Although this is all happening before rate. If we do see it get worse, we're going to see continued selling. Things can continue to get worse from here. Bonds have nothing to really provide support. We're looking to see them try to hold around the 200-day moving average, but it's really going to be crazy. The outlook for the next couple of weeks is brutal, and that's why, I mean, I'm definitely in that position where I'm gonna put lock on Okay. There you go. So I'm putting this so it pops up on the bottom of the screen. Lock advice in the next locking. Risks favor locking. We're not likely to see this equal a turnaround at all. And then we've got in the next 15 to 30 days. Remember what we got coming up on the economic calendar. So tomorrow, I don't think there's what is there tomorrow? I don't think there's much of anything. There's something small for tomorrow. Tomorrow is consumer sentiment, right? So we're going to see consumer sentiment. We're going to get durable goods. Um, there's nothing really there that's going to give us any hope that we're going to see improvement. I know you guys can't see that. Let me pull it over here. There's nothing here that gives us any hope of improvement, though. So I'm going to pop that away. We got to take a look and be realistic at what we got going on with the next couple of weeks. So a week from next week, we got JOLTS data. We've got the ADP report, which is going to be much less of a thing. You got another jobless claim. So jobless claims this morning came in at some of the best levels. Let me go ahead and show you guys some of this. Let's go to some of the headlines here, right? So here's what I was looking at this morning, reading a lot of Bloomberg this morning and all the different stuff going on there. Of course, you've got all the election talk. Yes, there is what's called the Trump trade, and it has become more pronounced. A few weeks ago, we weren't really seeing it. You are seeing a lot more of it now. At least it's being talked about, right? Ron said next big data will be on Halloween, the Fed's favorite measure of inflation, PCE. Yes, and let's remember that the CPI did not come in all that great this month. So when the PCE comes out, keep in mind that that probably not going to be all that great. And that comes out on Thursday. Then Friday, we've got the actual jobs data. So, but let's go into that. Let's talk about a little bit about jobless claims and stuff going on here first. Jobless claims were down again this morning. So when we look, I mean, Ron, you and I know you got stuff from like Danielle DiMartino Booth, but when what's being reported on jobless claims is been pretty standard for what we've seen. It's down a little bit back to 227,000 applications. They say that it spiked a little right before the hurricane. You can see it right here. It was kind of down, and then it spiked up, and then now it's back down. So living in the area that I live, yes, there were some people that have lost jobs, but not tremendously. I don't know why. I don't know so much about Florida, maybe, but not in North Carolina. Ron said we can look forward to more seasonal adjustments next week on the jobs report. Yeah, and that's the thing is the seasonal adjustments really leave this thing open. If you believe that there was any kind of hanky-panky on last month's jobs report, then you've got to believe that they're gonna double down on this month's because it's November 1st, right before. And I'm just gonna pull up the calendar here from Rate Alert so that we can look at a calendar together, right? So here we'll do monthly view. Okay. So, I mean, let's take a look at the calendar here, right? Tomorrow is Friday the 25th. We've got on the 31st, we got that PCE data. On the 1st, we're going to have the jobs data. And then, of course, when you go into November 5th is the election. November 7th is the Fed meeting. And then November 13th is the next CPI data. So, there's just this one not even paying attention, but I'll tell you, inflation will absolutely become a focus again, depending on what is said at this Fed meeting and how the labor market data comes in here. So let's remember something. When the Fed said, okay, we see inflation improving, but the labor market is in trouble and we need to focus on it, that turned all of the focus of markets onto labor data, and we have not seen the reactions to the inflation data. As we head into the next couple of weeks, as we get into that Fed meeting, you're going to see a lot of questions, especially if this is a strong labor report. You're going to see a lot of questions about, hey, Powell, do you think that inflation is still in, do you think we're going to see a double? All the talk of a soft landing has started to disappear. Now there's a lot of concern that inflation is going to kick it back up a notch. All right. Now, if we see markets start to give up the ghost on Fed rate cuts, we're going to see mortgage rates push up three quarters of a point higher from here. Right now, markets believe that we will get at least a quarter point cut in November because the Fed came out swinging in the September meeting. They did a half point rate cut. Markets believe they have to at least continue that momentum. However, December, we are at a less than 70% expectation of another cut. Okay, so they think they could pause. If we get strong labor market data next week, this is going to drop even further. This column where they would stay the same at 4.5 is going to go up and rates are going to move higher. Beyond that becomes the January, the March, the May numbers where everyone will be looking. If we see strong labor market data, Trump wins the election, and depending on what's said at the Fed meeting, you could start to see this play out in a scenario where markets believe that the Fed is going to have to stop cutting rates. Okay. That would push mortgage rates higher. That would keep mortgage rates higher. A month ago, we had such a wonderful outlook. It would look like the labor market was slowing, the inflation was continuing to slow, the Fed was going to need to start cutting rates. Things were going to be nice and easy. All right. Ron pointed out, let's see, I'm going to get some comments here. Ron pointed out that the Fed moved their meeting date to after the election. They should know who the next POTUS will be at their meeting. I wonder if the Fed policy could be influenced by a new POTUS if they feel one side or the other will be inflationary or not. Ron, I think you think, yes, it will definitely play into their mind, but they will never admit it out publicly. They will say that their focus is on such and such. They're not going to talk about the Trump trade. They're not going to talk about tariffs. They're not going to get into any of that. They're going to be very, very careful. But behind closed doors and in their own minds, absolutely, it's going to come into play, at least how they believe it. Now, again, whether Trump is the one that is the one that's getting accused of creating a higher inflation picture, whether that happens or not, totally, we're going to have to see. Like you said, we may see subsidies from the Chinese government to keep that from happening on the tariff side. But that's what's being continued on. Ron said, look at the continuing jobless claims. They're going the wrong way in significant numbers. Yeah, and there was argument about that too, about the continuing claims. Initial claims decreased by 15,000. Where is the continued claims? Continuing claims increased to nearly 1.9 million, the most in almost 3 years. So, but this is not getting the gist of the headline. But yes, Ron is absolutely correct on that, by the way. You're looking at people that are staying on unemployment is what continued claims are, as it sounds like, continued claims. So that's something that, it needs to be paid attention to, but there's an argument about why that is and the different things going on. So overall, a couple of other things. Election anxiety is building in the bond market. It's getting a tremendous amount of press, and it's probably playing an actual role at this point. Okay. There is a lot of talk of the red wave. So remember something. The election, we focus on the figurehead, whether it's Trump or Harris, but it's also, if you have gridlock where you have a Republican president, but a Democrat-controlled House, in Congress, or a Democrat president and a Republican House Congress, very little things are going to get done. There's going to be a lot of infighting, a lot of haggling, and not a lot of things getting done. If you get a wave, a blue wave or a red wave, and right now they're looking at a red wave, anytime there's a wave, that means you're going to have the House and the president. And I say the House, but it's Congress, Senate, and the House. The Congress and the president that are of the same party, it's the idea that you're going to see a lot more rubber stamping, a lot more of things pushing through. This is actually more of the concern, is not just that what the president will be, but what will the entire legislative and executive branches be to one party. So that's definitely something I haven't talked a lot about, but it is a big concern. If Republicans have full control over Congress and the White House, the thinking goes they would usher in more spending and tax cuts on top of the inflationary pressures of Trump's proposed tariff regime at a time when U.S. borrowing is highly elevated. More borrowing, that means a glut of debt. In order to pay for this stuff, we're going to issue more treasuries. More treasuries means more supply, which means less demand, which means that's why you're seeing the 10-year treasury yield, not mortgage bonds, but that's why you're seeing the 10-year treasury yield increase the way that we have. Okay, so I'll put this on 3 months so you can see it here. That's the argument on markets are preparing ahead of a red wave for the idea that if we were to see that, it would cause a lot of borrowing. There would have to be borrowing to spend on all these programs and to give these tax cuts and all that stuff. And that borrowing will equal more supply, makes the price of the bonds go lower because you don't need to pay as much. That drives the yield higher. That's a lot of what we're seeing right now on here for this. So you've got to, all that adds up to more fuel for a sell-off of the Treasury market, already mired in one of the worst losing stretches of the year. Bonds are on course for their first monthly decline since April, when the 10-year headed towards 4.25. The prices are steadying today. Of course, there are other reasons. Yes, exactly, for investors to sell bonds, especially as the strength of the U.S. economy leads traders to price in shallower path of Fed interest rate cuts. And again, that goes beyond the November cut. The November cut is pretty much a given. Markets believe that we're going to see a November Fed rate cut. However, as we get into December, January, March, May, as we go deeper into those months, looking at January, look at this. A month ago, markets were pricing as low as 3.25. There was a 40% probability to be at 3.5. That has moved all the way up to 4. There was almost 40% probability to be at 3.25. So a month ago, markets figured we would be at the highest 3.75, maybe 3.5. Now they're looking at that we would be at 4.25 and possibly 4. Right, with some outliers that we may even be at 4.5. So that's what you're seeing happen right now, and that's what you got to remember. That's what's being priced in, and how all this stuff is working, and what's being done. How our Treasury selling off like it's 1995. Bond market analysis by John Authors over at Bloomberg Opinion. No, this is a different opinion article. Anyway, that's kind of where we're at and where things will go. So my advice, no, Jay, this isn't a replay. I'm still babbling. This is why I'm in such a lock stance, because with so much going on over the next couple of weeks, floating is so risky. And we would have to see another pivot, another momentum shift. It's possible, but it's unlikely. That's the problem. All right. Ron said, if Elon Musk joined the administration, maybe we could finally see some legitimate cost cutting in DC. He cut 90% of the Twitter employees, but did need to add some back. Good start when we have a government shutdown. We see how many government workers are essential and how many are not. Exactly. But anyway, that's enough today, y'all. Tomorrow, I'm going to keep it short and brief. I'm going to be on the road, going to see a concert tonight, Sugarland and Little Big Town, with my wife over in Greenville, South Carolina, and I'll be staying at a hotel there. It's a 2-hour drive right now, 2 hours and change drive. So I'm not going to want to come home after the concert. So I'll be coming to you from a hotel tomorrow, and not going to have a tremendous amount to talk about. We'll see how things go. But as of right now, by the way, mortgage bonds barely. Thank you, Amy. I will definitely have fun. Barely holding those gains this morning. It's chipping away. So I think we're going to end the day worse off today than before there. So, and that's reflected in my lock advice. So thank you, y'all. Have a fantastic day, and see you guys tomorrow. Bye-bye.